Hi, everyone. Welcome to 2022, the year in charts. These are the charts and themes that tell the story of 2022. So let's rewind and go back to that very first trading day in 2022. And the year started off with a bang. So it looked a lot like 2021, that very first trading day. You had the S&P 500 closing at yet another all-time high. We hit 70 of those in 2021. Another all-time high that very first trading day. And you had Apple, the bellwether, hitting yet another market cap milestone, becoming the world's first $3 trillion company. But really, the similarities between the 2 years, between 2021 and 2022, would end on that very first trading day, because the S&P 500 never closed higher. It peaked that very first trading day, and Apple did as well. And in many respects, if you took a step back and looked at the macro picture, 2022 was setting up to be the polar opposite of 2021. These are a number of the macro factors I laid out in early 2022 that were going to paint a very different picture in 2022. So we had that free money effect, trillions of dollars in stimulus in 2021, really helping the markets. In 2022, this effect of the stimulus was really starting to wear off. 2021, very easy Fed, 0% interest rates, quantitative easing. They were still buying mortgage bonds despite the boom in the housing market. In 2022, the Fed early on is talking about tightening, hiking rates, ending quantitative easing. The smooth ride higher that we saw in 2021, very unusual. The pullbacks were all very small, and the S&P 500 just raced back to new all-time highs. Early in 2022, we're seeing more volatility, potential for higher drawdowns. Then you had the earnings boom in 2021, hitting record highs, S&P 500 earnings every single quarter in 2021, record profit margins expanding to heights that we've never seen. And in 2022, you're just going to have the reality of tougher comps, and it's going to be much more difficult for companies to pass on those higher costs to the end consumer, meaning margin compression. The attitude about inflation, I think this was a very important one. In 2021, it was, don't worry about inflation. Essentially, it's transitory. It'll come back down on its own. You had the Fed saying this, the federal government saying this. In 2022, this attitude shifted. People are worried about inflation. The Fed's worried about inflation, and people are talking about stagflation being a risk. Then you had the housing market, just an unprecedented boom in 2021, record highs in terms of appreciation, and ultra low mortgage rates driving that. And in 2022, you have rates moving upward, a housing slowdown likely to occur. And lastly, the series of rolling manias that we talked about in 2021, from meme stocks to crypto to the record issuance of IPOs and SPACs to high growth stocks and technology stocks, all of that boom was set to see the other side, which is the weighing machine, which is the idea that securities eventually will start to move in the long term to their fundamental value. So all of these factors paint a very different picture of 2022 than 2021. And to me, there was no more important shift than the shift at the Federal Reserve and the end of easy money. And this is a huge one, because we've been accustomed, market participants have been accustomed to a certain kind of Fed in recent decades, and that's been an easy Fed, a benevolent Fed, a Fed that was always willing to throw money at the problem at the first sign of turmoil. And indeed, if we look at the last 8 bear markets in the US before 2022, they all had something in common. That was the Fed swooping in to save the day. It started with the Greenspan put 1987 crash, cutting interest rates, but it would continue from there. And pretty much every Fed chairman used this template whenever there was a market downturn, whenever there was high volatility, the Fed would provide some comfort, either through quantitative easing or rate cuts, or just language to suggest that the Fed was going to be easier going forward. But a strange thing happened in the beginning of 2022. We very quickly had a 12% correction in the S&P 500. And not only did the Fed not step in to save the day, but they actually reiterated that they're going to hike interest rates, they're going to end quantitative easing, and they're going to do this in spite of the market's turmoil. So very different. It became clear meeting after meeting that there was a new sheriff in town, and this Jerome Powell looked very different than the Jerome Powell that we saw in the past. And let's talk about inflation, which is really driving this shift. Thomas Sowell, great economist, once called inflation the most universal tax of all. He said it was a way to confiscate people's wealth from them without having to openly raise taxes. And if we look at the middle of 2022, we go to that June CPI report. This was the highest rate of confiscation that we've seen since the early 1980s. So US CPI 9.1%. That was the highest we've seen since 1981. And the Federal Reserve is still far behind the curve, with only the Fed funds rate at that point moving up to 1.5%. And the important thing is really what was driving this inflation. It wasn't just one area, it wasn't just one factor. It was every single major component of CPI moving higher together. And so this is a look at those major components, and really energy was leading all of these higher. Everybody's talking about the price of gas in the middle of 2022 because we had the price of gas rising over $5 a gallon. That was the national average. In some places was even higher than that. And that was by far the highest level we've ever seen for gas prices. In 2008, the prior record was a little over $4 a gallon, so significantly higher. Everyone's talking about rising gas prices, rising food prices, rising inflation. So at this point in time, the market, middle of 2022, had deteriorated. So that 12% correction had gotten even worse. Then there were fears about recession. You had a downturn in GDP, as we'll talk about later. And people are suggesting that the Fed should stop right there. They should pause. They should not continue on their tightening path. So really, the Fed had a choice to make. Do they stop or do they continue? They ended up choosing the latter. And this is the big reason why, I believe. So if we looked at the Fed's language, really saw a shift in what they were saying by the middle of 2022. All of a sudden, they're talking about the American worker, and they're talking about if they don't bring about price stability, then there can't be prosperity for the American worker because you have a loss in purchasing power. And this chart really illustrates why. So 20 consecutive months now, we've seen price increases, so inflation, outpace the people's wage gains. So you don't want to see this. You don't want to be on the bottom end of this chart, and you certainly don't want to be there for 20 consecutive months. So the Fed's shift in attitude is really in focusing on this chart. In 2021, they ignored this factor and said it would just come down on its own and get better by itself. But in 2022, they said, no, we have this mandate. It's called price stability, and we have to be the ones to bring this about. If we raise interest rates enough, that's going to curb demand, and that will bring down the rate of inflation. And as we saw by the end of 2022, it began to work. But if you look at this chart, you might ask the question, well, how is the US consumer, how is it possible that they're still maintaining their spending if their wages aren't keeping pace with inflation? It's a great question, and it's something that we've talked about last year a ton, but I want to talk about it again here because it's been such a huge story in 2022 and will be in 2023 as well. So we have two factors really driving that maintenance of that spending. You have that consumers chose to lower their savings rate. So they're saving less money and they're maintaining their spending, and they're also borrowing more, which is really the American way, of course. If we can't afford it, we borrow it. So these two factors are keeping retail sales from collapsing due to these rise in prices, and the rise in prices outpacing the wage gain. So in 2023, these two charts are going to be very important. The big question is, does the U.S. consumer reach a breaking point where they either say we can't save any less, or we shouldn't or can't borrow anymore? And I think when that happens, then you're going to see a shift, of course, in retail sales, and the economy will likely, the downturn will likely weaken at that point. So that's going to be something very important to watch in 2023. But getting back to the Fed, why are they still saying at the end of 2022 that the job is not yet done? Well, it's going back to that chart. we're not yet in the point where wage growth is positive on a real basis. And so they're saying they have to continue. And that means two things. Number one, the balance sheet is likely to continue to go down. The reduction of the balance sheet in 2022, 2.4%. That was the first decline we've seen since 2018, but still very small given the run up, right? So we had a few $1 trillion expansion in the balance sheet, over $4 trillion from 2019 to the end of 2021. And we've only just really started to reduce that at 95 billion a month. If that were to continue in 2023, we'd see a much bigger decline. This would be over double digits. It would be the largest annual decline on record, but still it would be a little over $1 trillion and still leave the balance sheet well above where it was in 2019. So for now, Fed is signaling we're going to continue to reduce that balance sheet until the job is done. And number two, more importantly, we're going to continue to hike interest rates. And this is a chart I think that would have shocked people. If you showed this chart to someone at the beginning of last year, they probably would have said that you're crazy. The Fed's never going to hike that much. Nobody expected that. Nobody predicted that. The Fed themselves at the end of 2021 were saying, we're going to end 2022 with a 0.9% Fed funds rate. So just way off, way underestimating where that Fed funds rate would end up. And that's because they got the inflation picture wrong. It wasn't transitory. It hit that 9.1% level, highest since the early 1980s. And the Fed had to do something very different. And they did. They rose interest rates 4.25% in 2022. This is the highest level, year-end level that we've seen since 2007. And what it means is two things. So who does it help? Who does it hurt? Who does it help? It helps savers. So if you have a savings account or a checking account that's earning nothing on your cash, you can now get over 4%. If you look at the highest online savings accounts, they're above 4% now. This is good for investors who have cash in their brokerage accounts as well. You can get money market fund yields over 4% as well. And if the Fed continues to hike interest rates in 2023, these rates will only increase as well. So very helpful for savers. Anybody who has cash can earn a higher yield without taking any additional risk. And who this hurts, of course, is debtors. So people taking on debt. If you have debt that's resetting at higher levels, it's going to be much more painful and much more difficult to service that debt with higher interest rates. And number one on that list, of course, is the U.S. federal government. And if we look at this table here, it's really remarkable. But the one thing that didn't change too much in 2022 was the fact that national debt continued to rise. We hit two more milestones, now above 31 trillion in terms of total national debt. So even with inflation hitting a 40-year high, that did not stop the federal government from borrowing money and spending it. And you had about a $1.3 trillion deficit in 2022. So still pretty sizable, much less, of course, than 2021, but still pretty sizable. And for a long time, people dismissed this table. They said it doesn't matter because interest rates are so low. That really counteracts any level of debt. It doesn't matter how big your debt is if your interest rate is so low, because it's going to be easy to service that debt. But I think that thinking really changed in 2022, at least by the end of the year, because now it's becoming much more difficult in terms of that interest expense to pay off that debt. So this chart here shows you the interest expense on U.S. public debt, $766 billion by the end of the year. And that's the highest level we've ever seen. And if you notice the trajectory here, it's moving higher at a rapid pace. And the reason for that is you had all of those short duration securities maturing. So 1 month, 3 month, 6 month treasury bills where the government had financed at very low interest rates are now resetting at much higher interest rates. And so if this pace continues, if we take the pace from the past few months and it continues in 2023, we could at some point see this cross above $1 trillion and become the single largest line item in the U.S. federal budget. And that would surpass Social Security if it does that. So I think this is going to be a chart where a lot more people are talking about in 2023. Now that you have a split government, it's going to be even more difficult, I think, for the federal government to have huge expenditures in terms of new stimulus bills. So perhaps we're going to see the impact on national debt, where it's not going to increase as much. But this is going to be a big factor. People are going to be talking about it as long as interest rates remain elevated. And if we look at that Fed funds rate, we put it in perspective. At the end of 2022, that increase was the largest since 1980 for a single calendar year. So pretty big increase. We haven't seen the Fed be this aggressive since Paul Volcker in 1980, when he broke the back of inflation by driving that Fed funds rate up to 20%. And it wasn't a risk-free thing to do. By driving interest rates that high, he drove the economy into a recession, but they viewed that as necessary. Bringing down inflation was so important that even driving the economy into recession was necessary in order to make that happen. And I think today, even though the interest rate rises, as interest rate levels are not nearly as high, it's a similar level of thinking the Fed is risking a slowdown. And they're doing so because they're saying bringing about price stability for the American worker is that important, that we need to risk a slowdown in the economy to do so. So the important thing here for bond market investors is that the starting point in 2022 is very different than the starting point in 1980. So 13.8% Fed funds rate entering 1980, essentially zero entering 2022. And for bond market investors, that would really make all the difference. And what we saw in the bond market was really just a bloodbath of epic proportions. And this was a big change for bond market participants. We've become accustomed to bond yields only moving in one direction, and that's down the last 40 years, from the peak in interest rates and 15.8% on the 10-year in early 1980s down to the low in 2020, 0.5% 10-year. It was pretty much a one-way move down. And because prices move inversely to yields, as yields fall, that's a tailwind for bond prices on the upside. So in 2020, we just saw this enormous surge of bond prices moving higher when interest rates fell and hit all-time lows. But that was the past. All of this that went on in the past does not predict the future. Past is not prologue in markets, as I like to say. And the situation entering 2022 in the bond market was really a powder keg just waiting to explode. So you had three main factors leading me to believe this was going to be a pretty difficult year for the bond market. Number one, you had that 10-year at 1.5%. And at that point, you already had inflation over 6% entering 2022. And you had the Federal Reserve, of course, talking about hiking interest rates. And finally, you had the inflation rate still moving upward. So all of these factors were going to be causing much difficulty in the bond market, but I don't think anyone anticipated the difficulty would be as big as it was. And this is the reason why that occurred. You had just had an across-the-board rise in interest rates from the short end at 1 month to the long end at 30-year. All maturities moving higher compared to their end of 2021 yields. Obviously, the biggest increases were at the short end, with the Fed moving from off of zero. But even at the long end, you had the 10-year yield more than doubling, 30-year yield more than doubling. And the way bond math works is if you have a very low starting yield, your duration is higher. And duration is simply your sensitivity to changes in interest rates. So when you have this huge increase in interest rates and your duration is very high because interest rates are starting at a low point, your sensitivity is that much greater. And in simple terms, there was simply no cushion for bond investors. So you had no coupon yield to cushion that blow. And the end result of that was the worst year in bonds in history. And what really wasn't even close. If you listen to market participants before 2022, they would always have war stories about 1994 and how difficult it was in the bond market, the rise in interest rates and bond prices going down. In hindsight, it really looks like nothing in 1994, 2.9% loss. That seems like almost nothing, but at the time it seemed like a lot because that's bond investors just hadn't experienced anything that deep. But in 2022, it really rewrote history, more than 4x larger than the 1994 loss, 13% decline. If we look at treasury bonds, so longer duration, and now we have more history on the returns from treasury bonds, 17.8% loss. Data going back to 1928, by far the worst year in history for the 10-year treasury bond. And the difficulty, if you're a bond investor, is that the pain was really across the board. The worst securities, of course, were those long duration securities, so long-term treasuries and zero coupon bonds, but everything was down. Investment grade bonds had their worst year in history. High yield bonds, worst year since 2008. International emerging market bonds got hit as well. The only real place to hide was in treasury bills and very short duration investment grade bonds. Everything else really got crushed. And this was a surprise for bond market investors because you just hadn't seen these types of declines. You had, if you owned long duration treasury bonds, the declines were larger than the S&P 500 and by a good amount. So very different story from the stock market, where investors have really come to learn that the drawdowns that you experience are commonplace. It's really the price of admission for earning higher returns. So if we talk about the stock market in 2022, the prices were down, but it wasn't as big of a shock, I think, because we've seen it before. So in 2022, 18.1% decline for the S&P 500. That was the worst year since 2008. But we've seen these types of declines before. We've seen it, of course, after the dot-com bubble burst. We saw it in 2008. We saw it in 2020, but the markets recovered. So the year-end price really didn't reflect that volatility that went on. But it's something that you see in the stock market from time to time. And it's just something that investors have to bear if they want to earn the higher return in stocks. So if we talk about some of the catalysts for this decline, there's really no shortage of things you could point to. We've talked already about inflation and rising interest rates. That was certainly a big issue. But just looking at the fundamental picture in terms of S&P 500 earnings, they're moving now in the opposite direction that they were in 2021. So we saw a decline in earnings in the second quarter and third quarter, down 10% year over year. As we talked about, tougher comps, and we also had margin compression. So a number of companies talking about, from Walmart to Target, number of companies in the retail space saying it's harder for them to push on those higher costs to the end consumer. And as a result, their margins have gone down and earnings have gone down as well. So pretty big factor, in addition to the other headwinds, was just simply earnings moving lower. And if we look at the S&P 500 and where it was in October, this was now the longest correction that we saw. You have to go back to 2007 to 2009 at 9 months. So we've seen bear markets in the past. The unusual thing about the last few bear markets is just the frequency of them. So historically, if you go back to 1928, you see on average a bear market in the S&P 500 once every 4 years. But as I often caution, if you look at the average, that doesn't mean you shouldn't expect one only once every 4 years. They can be lumpy, or they can go long periods of time without having one. And so what we've seen in recent years is them really concentrated in a short period of time. We've now seen 3 bear markets in the S&P 500 in 4 years. And so we had the 2018 one, which of course markets would recover in 2019, the 2021 markets would recover that same year. But this one is lasting a little bit longer. And again, you have to go back to that 2007 to 2009 to find a period where the S&P 500 went this long in terms of a correction. So if we talk about volatility, much more volatile year in terms of stocks. This table really illustrates that. Going back to 1940, only 3 times did the S&P 500 have declines in trading days of 1% or more this many times. So 1974, 2002, and 2008 all had more, But other than that, this was the most downside volatility that we've seen, 63 trading days where the S&P 500 declined 1% or more. And this is what I like to call the price of admission. And for in 2021, risks seemed to be absent. It seemed to be gone. All news was good news. But we saw the opposite in 2022. And it's just an important reminder for investors that there's a trade-off. You don't receive this higher return, long-term return from stocks without periods of pain, without periods of higher volatility, with drawdowns, with corrections, with increased risk. So there's an equation in markets: higher risk, higher return, and in the short run, that can really diverge, but in the long run, that's the main reason why you're being compensated with a higher return, is because you're taking on more risk. So investors really learned that once again in 2022. What made it more difficult, the stock market decline, was the fact that bonds really didn't do what they've historically done, which is kind of cushion the blow. If we look at the bear markets or down years for the S&P 500 going back to 1976, the bond market, the Bloomberg Ag, was up in all of these years entering 2022. So very different story in 2022, where you had stocks and bonds both moving down together. So very different picture for investors. And why was that the case? Why was it the fact that both stocks and bonds are declining? Well, it's because the proximate cause for the S&P 500's decline is that rise in interest rate, that rise, fears about inflation. And of course, when inflation is rising, not very good news for the bond market. So to put it in perspective, going back to 1928, these are S&P 10-year and 60/40 returns. And this is something we really haven't seen before in history, where we had both the S&P 500 and 10-year Treasury bond down double digits on a percentage basis. So we've had years in the past where both stocks and bonds finished lower: 1931, 41, 69, 2018. So relatively rare. We don't typically see this. But even in those years, you didn't see the losses on the bond side, almost equaling the stock side. So very difficult year. And the reason for this rising correlation was simply the common enemy of high inflation. So high inflation is obviously bad for the bond market, but also in 2022, not very good for the stock market. So speaking about inflation, let's talk about the housing market. There's no expense in for U.S. households that's bigger and more important than the expense of housing. And in 2020 and 2021, we just saw this enormous boom in terms of home prices. In 2021, we also saw a record increase in rents. So really, if you're just being objective, looking at the data, this was now the second, all evidence pointed to a second housing bubble that the U.S. has experienced. And if we look at this chart, it illustrates the reason why you can call this a bubble. We're just adjusting for inflation. Home prices that had never been higher than they were at the middle of 2022, far in excess of the last housing bubble. And this was a problem. Home prices by themselves being extremely high, of course, problematic. But the fact that you have super high home prices and mortgage rates moving higher caused an absolute collapse in affordability. So this is what happened to the 30-year mortgage rate in 2022. It essentially went from an all-time low in 2021, 2.65%, all the way up over 7%. Just an enormous record increase on an annual basis. We haven't seen 7% mortgage rates since 2002. So go back 20 years. And this really changed the picture in terms of what's affordable for most Americans in purchasing a home. And just to put that in perspective, the 3.3% increase in mortgage rates in 2022, highest ever, data going back to 1971. So a big sea change in terms of the mortgage rate moving higher. And that coupled with the 40% increase in home prices in a 2-year period really led to a lack of affordability, the likes of which we have never seen. And this chart really illustrates that. It's showing you the median house payment needed as a percentage of your income to afford that median home price, 46%, just far above anything we've seen before. And if you get to this level where you need to spend 46% of your income to afford a home, most people can't do it or won't do it, or the bank won't lend to them at that level. And what that causes is just an absolute collapse in demand. So this is really demand destruction 101, because if you can't afford something, you're not going to put in a bid for it. And now you're going to have activity collapse because of it. And that's exactly what we saw. If we look at the home sales data, this is existing home sales just absolutely collapsing. New home sales chart looks the same. And initially, when it starts collapsing, there was this theory similar to the last housing bubble, actually, that people aren't going to sell their homes. They're just going to wait it out, and prices therefore wouldn't fall, because if you don't sell your home, then I guess prices won't fall. The problem with that thinking is someone eventually has to sell. You're moving, there's a change in situation, and you have to sell your home. And when you sell your home, it's going to clear based on supply and demand. And if demand collapses, prices have to move down to reflect that. And so we're just starting to see that in terms of overall US home prices. They're down around 10% from their peak in June. And the expectation is we're entering the slow winter months for the housing market. The expectation is we're going to see more declines to come. And it's really because of that affordability picture. So unless mortgage rates miraculously move back down, you need to see home prices move down in order for the average home to be affordable to the average American. And important point here, just like the last housing bubble, the aftermath, we're seeing home prices decline in pretty much every major city. So it's not limited to just one particular area, let's say, that had a huge increase. Every major city in this Case-Shiller 20 city index has declined now for 3 months in a row. We haven't seen that since late 2008. So all evidence is pointing to housing market weakness and further weakness to come until that affordability picture really changes. And if we talk about the change from 2021 to 2022, housing market was, of course, a very big one. But I think the attitude from investors, that sea change was just enormous in markets. We went from a period where everyone was saying stock picking is easy to stock picking is hard very quickly. And so the meme that had persisted throughout 2020 and early 2021, stocks only go up, that was seemingly absent in 2022. Nobody saying stocks only go up. You have a very different picture in terms of speculative activity and the demand for new issuance. If we look at this SPACs table here, I think it tells the story here. Record issuance in 2021, just a collapse in 2022. And then we saw the other side of the boom. So boom became bust. And this is a table showing you all of those high growth winners from 2020 that had just enormous percentage increases. If we look at the 2021-22 declines, that erased much, if not all, of the gains for many of these names. And it was really a across the board shift in terms of valuation. So we went from a period where valuations didn't matter because interest rates are low and we have the stimulus, we have money supply increasing, to all of a sudden valuations matter because growth is slowing, interest rates are rising. So just a very quick shift in terms of the mentality of market participants, where they came from the belief that stock picking is easy. You could literally thrown a dart on the wall at any high growth company or tech stock in 2020, and it was likely to go up to the point where very difficult to find something that's not going down. And if we look at that high growth boom and bust, I think no fund, no ETF really tells the story better than this ARK Innovation ETF. In early 2021, it was raising $1 billion a day in terms of new assets. And that was coming from just the enormous performance in 2020. And this ARK portfolio in early 2021 had a collection of names that were just so extremely valued that we haven't seen something like that since the dot-com bubble. We saw a median price to sales ratio of the companies in this ARK ETF at over 30 times sales. That's the median. So just a number of companies that had extremely high valuations. And without exception, every single one of these names was re-rated. The result was 80% drawdown in this ARK ETF and the elimination of all of the outperformance that had existed and then some. So if we compare ARK to NASDAQ 100, over here, stock picking is easy. Over here, the reality stock picking is indeed very hard. And it's just as hard to pick managers or funds that are going to be good at stock picking because over the long run, most, of course, active managers fail to outpace their benchmark. So if we talk about the single name that really embodied the boom on the way up, and it was ARK's largest holding over for most of this period of time, we have to talk about Tesla, of course. And Tesla, just an enormous run up in 2020. And that kind of reversion to the mean that occurred in other high growth stocks, it didn't escape Tesla. So Tesla itself had a price to sales ratio of 30 times in early 2021. And that was simply a function of the stock had gone up 8x in 2020. That was up 8 times its value from the start of the year in 2020, but its sales were only up 25% that year. So it had pulled forward years of expected growth. And if that growth slowed at all, or market conditions changed or sentiment changed, you're likely to see a revaluation in the stock, which is exactly what we saw. I think Tesla ended the year at around 5 times sales, so significantly lower valuation, and the drawdown in Tesla over 70%. And I don't think this was unexpected, but largest drawdown ever for Tesla. And a lot of the money that had poured in to this high growth stocks and the high growth ETFs at the boom came in after the price appreciation. So if we look at a total dollar value of gain or loss in funds like that ARK Innovation ETF, you would actually see more dollars lost because of the money that came in after the fact and then the large drawdown. So Tesla was not alone. High growth stocks were not alone in terms of this reversion to the mean. The weighing machine also hit meme stocks, of course, in 2022 with significant declines off of their 2021 mania highs. So in the midst of a mania, it seems like nothing can deter that price increases. All that matters is that someone will pay a higher price, and that herd behavior, that FOMO mentality really takes hold. But on the other side is always this weighing machine that Ben Graham talked about, which is the idea that in the long run, you're likely to move down to your fundamental value. And we started to see that with meme stocks in 2022, even the two big ones, AMC and GameStop, showing significant decline. So the lesson here is the same for investors. Don't chase, certainly don't chase after the fact. Buying based on a herd belief and price alone, that prices are you're going to be selling to the greater fool. Well, you run the risk of you yourself becoming the fool. And I think many investors who bought near the high and were being pushed to buy and induced to buy near the high learned this the hard way. And unfortunately, all of those stories of riches that went on in 2021 from these meme stocks, you haven't seen the other side. You haven't seen the lessons learned from that just yet. Maybe we'll see that in 2023. If we're going to talk about booms and we're going to talk about busts, we got to, of course, touch on crypto here. And I think the big factor helping crypto, helping risk assets in general on the way up was certainly this increase in the money supply. 40% increase in the US money supply in 2020, 2021. I haven't seen anything like that in history. And that was a huge driver for the speculative mania that we saw. And interesting thing is you never hear the Fed talking about this as a driver of inflation, but this is, of course, one of the key factors that pushed inflation up as high as it did. But again, that was the past. In 2022, very different picture. The money supply is on pace to contract for its first year ever with data back to 1959. course, during the Depression. We don't have the data here, but it did decline for that period of time. But other than that, you've pretty much seen a persistent rise in the money supply. Different story in 2022, and that would have ramifications across all asset classes, and crypto no exception. So again, 2020, 2021, great year for Bitcoin, outperforming pretty much every major asset class. 2022, other side, Bitcoin down a significant amount, and every major crypto coin suffering declines. And two on this list that we need to talk about just a little bit here: FTX token, of course, from that massive fraud, uh, taking money from customers, putting it in their own cryptocurrency, and then that cryptocurrency proceeding to lose 98% of its value. You also have this idea of stable coin, and I think this is an important point because investors should know, but they have to learn from time to time again that if it seems too good to be true, it probably is too good to be true. So this Terra US dollar is a stable coin that was promising yields of 20% or higher. And when interest rates are zero, that seemed pretty good. And unfortunately, a lot of investors put their money in this thing, and it proved to be anything but stable, losing 98% of its value. So crypto, no exception to the reversion to the mean rule, and the rule that you can't have tremendous upside in terms of the gains that we saw in 2020 and 2021 without the risk of downside. But in terms of expectations, I don't think that the mean reversion, the return to reality that we saw in meme stocks and crypto and high growth stocks was a shock to anyone. I think people were expecting it. You just didn't know when or how deep the declines would be. But if we talk about what was a shock and what was a fat tail, and by all accounts a black swan because it couldn't have been predicted, I think we have to touch on what happened with Russia and Russian stocks trading in the U.S. So February 2022, Russia invades Ukraine, and very quickly you just see these enormous losses in Russian stocks trading in the US, down 70 to 90%. These are the largest Russian companies. And then all of a sudden, the trading in these securities is halted, with no indication of whether they would ever resume trading again. They ended up not ever resuming trading again, but you have this Russian ETF that still traded after these securities were halted for a period of time, and just saw these stunning losses in single trading days, 33% decline in a single trading day here, which was a 16 sigma, 16 standard deviation event, which basically means, according to probability theory, if the markets were following a normal distribution, you would never see a 16 sigma decline in the history of the universe. But every single year we see these types of events in different securities, which means, of course, that markets don't follow a normal distribution. There's fat tails where extreme events happen with much greater frequency than you can predict under a normal distribution. But in this Russian ETF, and eventually trading is here halted as well, not before the stock is down 85%. But at that point in time, an unusual and what I'm calling a black swan situation occurred, where the major indices, so like MSCI, who ran these ETFs, they decided to remove all Russian securities from their indices at a price that was effectively zero. So it was just an unprecedented thing. We've never seen it before. They essentially did a fire sale, selling these securities out at a price that was effectively zero. And the result was just massive declines for anyone who was invested in these securities. The NAV by year end down 99.8% in this Russia ETF, by far the worst performer amongst global equity ETFs. It's probably the largest decline that we'll ever see for a country ETF. So another year, another fat tail black swan. 2023, you can expect to see another one. Of course, no one knows where it's going to occur. Let's talk about the economy. And in most years, you see a big debate about the economy. There's people that think it's going to do great. There's people that think there's going to be a recession, and there's people in between. But in 2022, I think this level of debate really rose to levels that we haven't seen in a long time. And that's because we just had a lot of different data showing different things. And number one would be the real actual economic data. If we look at real GDP, it ended up declining in both the first and second quarters. And every time we've seen that since 1949, consecutive quarters or more of negative real GDP growth, the U.S. economy was deemed to be in a recession by the NBER, who announces the official recession. But to date, they haven't announced an official recession, which means this two-quarter decline could be the first time since 1947 that we don't have an official recession with consecutive quarters declining in real GDP. But if we look at a few reasons perhaps why they're not going to say it's a recession, number one would be the fact that in the third quarter, GDP bounces back to hit a new high. And in the fourth quarter, they're expecting real GDP to be positive as well. So perhaps they could say it wasn't long enough to bring about a recession for that period of time. But at number two, I think this is a bigger factor. During recessions, you tend to see weakness in the labor market, but we didn't see that in 2022. Instead, we saw the greatest jobs comeback in history that I've called. It hit finally a completion where the 22 million jobs that we lost in March and April of 2020, all of those were added back and then some. So this was as of July, and we hit new highs in payrolls throughout the rest of the year. You don't typically see that, of course, during a recession. It's a coincidence, a lagging data point, but you tend to see at some point in time payroll starting to move lower during a recession. And you also tend to see the unemployment rate start to move up. It actually moved down again in 2022, 3.5% at year end. That's the lowest, tied for the lowest that we've seen since 1969. So hard to say that the economy is in a recession with the labor market that strong. A big driver of this was just simply the enormous number of jobs that we had available, over 10 million jobs, and people, the number of unemployed is still 4 million less than that. So still a tight labor market, entering 2023. The expectation is that's going to change. We're already seeing that in the tech sector with a number of layoffs there. But the expectation is the labor market will really start to normalize in 2023. And perhaps if the economy pushes lower, then we'll see this change. But for now, this is leading to a huge debate among market participants. We have data points in the housing market. We have data points in the yield curve. We have data points in retail sales showing now some signs of weakness. But we don't have the jobs market yet showing those signs. So there's a debate. Is the economy in a recession? It's going to be in a recession. But all of the leading indicators are pointing to one thing, and that one thing is a slowdown to come. This is a chart showing you the Conference Board's leading economic indicators, and it's a composite of a number of leading indicators. And every time, the past few times in the past, it's been at these levels, the economy was soon thereafter entering a recession. And the biggest one, I think, among these, the one that gets the most attention because it's just had the best track record in terms of predicting recessions, would be the U.S. yield curve. And here we're seeing that spread between the 10-year and 3-month Treasury yields not only go negative, but the most negative we've seen in quite some time. And every time we've seen it this negative in the past, a recession has followed. So pretty good track record in terms of predicting recessions, this yield curve inversion. But as you'll notice here in the table, the variability time is pretty wide. So it's been as short as 11 months, as long as 50 months, and the average is around 24 months. But I think this time around, very few people think that it's going to be one of these long lead times. A lot of people are thinking if the economy is not already in a recession, we're going to enter one in 2023. And this poll that I did in December really illustrates that. 85% of people saying the economy is either in a recession or will enter a recession in 2023. So if we look at 2023, I think the bigger surprise would be that the economy doesn't enter a recession. I think that would surprise a lot of people. If there was an official recession, I think the markets have to some extent priced that in. But the bigger surprise would be that the economy continues to grow throughout 2023. So if we look at the end of 2022, we left the year very different place than where we started. Of course, we started the year that very first trading day with an all-time high in the S&P, Apple hitting that market cap milestone. Very different point at the end of the year. Housing market had flipped, stocks have flipped. Obviously, we talked about the bond market, but if we look at just broad asset classes and how they did in 2022, we can see that only commodities and cash, so short-term treasury bills, finished the year higher. Everything else in the red, and pretty much very difficult year for a diversified portfolio. Most difficult year by all accounts since 2008. And if you're a bond market investor, the worst year that you've ever had in history. But in terms of this chart, what stands out, we have just simply the number of asset classes moving lower. So diversification in the long term helps a lot. In 2022, unless you had commodities and cash, diversification was not very helpful at all. That's an unusual year, unlikely to occur again in 2023. You're likely to see more dispersion, but this can happen from time to time. You can have asset class correlations moving up. That tends to happen during bear markets, but certainly not to this extent. If we look at the big winner in the stock side over the last decade plus, without a doubt, it's been U.S. high growth tech stocks, and particularly large technology stocks. And QQQ, NASDAQ 100 is really the leader in that sense, up 15% annualized since 2011. Entering 2022, this was above 20%. So the pullback changed that math a little bit, but still enormous performance from that NASDAQ 100. And that's because we had 13 straight years of positive returns for this index. So just an enormous run for high growth stocks for the big four: Apple, Amazon, Google, Microsoft. Just an incredible run of returns. And finally, some level of mean reversion here in 2022, with the NASDAQ 100 not only finishing down, but underperforming most of its equity peers. If we compare the NASDAQ 100 to the Dow finished much better than the NASDAQ 100, only down 7%. The number of securities actually positive in the Dow, particularly energy. No surprise there with the gains in crude oil, but Chevron leading all Dow components, technology stocks, Intel and Salesforce finishing the worst. And that kind of mirrors the sector picture that we saw. Energy, second year in a row, number one sector, this time far outpacing everything else. Only energy and utilities finishing positive, and then tech, discretionary, consumer services, so more cyclical sectors moving lower on the year and underperforming. So big year for mean reversion, big year for valuation compression. Certainly in these areas, it was a huge factor as well. And if we look at the best performers in the S&P, oil and gas dominating this list. Worst performers, you have a number of industries, but a number of prominent high growth names: Tesla, PayPal's in there, Meta, so Facebook, and so on. So you had, again, a kind of a flip from what happened in 2020, where energy crude oil went negative, and energy stocks hit their lowest levels in a long time, and on a relative basis just were significant underperformers. And just 2 years later, we have the flip side. So we went from negative crude oil to all-time high price in gas in a 2-year period. If you would have said that would have happened 2 years ago, people would have said that's impossible. It's never going to happen. The whole world is shut down. How are we going to have these higher commodity prices? How are energy stocks ever going to make money again? And just 2 years later, you see what goes on, and just proves once again there is no impossible when it comes to markets. If we look at commodities, the picture at the end of 2022 very different than the middle of the year. Significant declines off their highs, while they still finished positive. Heating oil, natural gas, a number of other commodities. The gains were much bigger earlier in the year, so just a huge move back down for the commodities, and a lot of that is due to fears of lower demand from a global slowdown. So the Fed was not alone in hiking rates in 2022. Almost all of the major central banks hiked rates. You're seeing slowdown in growth in many of those countries. And the expectation is that slow growth is going to lead to less demand, and commodity prices in turn will fall. I think lumber is the best representation of how that could play out because we just saw lumber extreme boom in lumber in 2020 and in early 2021 on the housing market. And then now we've seen the opposite, where as housing activity has collapsed, fewer homes are being built, home builder sentiment just plummeting. We're seeing lumber prices come back down. If we talk about sentiment, it was a very interesting year for sentiment. There was, of course, no shortage of things to be worried about. And I think the U.S. consumer really took that to heart, particularly in the inflation side. So this is the University of Michigan Consumer Sentiment Index. It hit an all-time low in 2022. Just really shocking in terms of how low consumer sentiment was. The fact that it was even lower than the 2008 financial crisis and recession, when we didn't even have an official recession in 2022. And then just the persistence of this throughout the year. So 8 straight months below 60 for this index. Prior to this, we'd only seen 4 straight below 60 in 1980. So very negative consumer. Whether this starts to translate into lower retail sales, that's the big question. It's seeing some signs of that the past few months. I think that's going to be the big question for 2023. And in the stock market, the list of things that investors were worried about, very long. You have earnings going down. You have the war in Ukraine. You have the fact that inflation's hitting its highest levels in 40 years, the Fed tightening, interest rates rising, all of these factors weighing on investors. And sentiment really indicated that, perhaps this is not a surprise, that investors would be more bearish. But I think the persistence of this bearishness is somewhat of the surprise. We saw a record 40 consecutive weeks where bears outnumbered bulls in this AAII sentiment poll. So if you're a contrarian, you'll view this as a positive. Certainly at extremes, we've seen better S&P 500 returns going forward from really negative levels of sentiment. So all else equal, if you're an investor, you prefer other investors to be bearish than bullish because you tend to see better returns going forward. So we'll see if this picture changes in 2023. But what's fascinating about the sentiment picture is, even though investors were much more bearish at the end of the year than they were at the start of the year, the opposite should have been true. They should have been more bullish than they were at the start of the year, because without exception, every major asset class had a higher yield at the end of the year than the start of the year. So if we look at treasury bills and treasury bonds, investment grade bonds, high yield bonds, and even the S&P 500 with a higher dividend yields were higher. And so that's good news for investors longer term, because your prospective returns tend to be highly correlated with yields and valuation levels. So even though investors are very negative, they actually should be more positive than they were at the start of the year, because yields are higher. And really, that's the upside of all of the downside that we saw, is the fact that investors are in a better position today, particularly in the bond market, for expecting better future returns. And let's talk about prices and narrative. So these were the charts and themes that told the story of 2022. But in 2023, the narrative is going to be different, and that's because prices are going to change. So the story of 2023 can't be written today because we don't know how prices are going to move throughout the year, and those prices are going to drive the narratives going forward. Everything from inflation to how earnings move, to all of these different factors are going to dictate how the story changes, and how people feel about markets and sentiment is all, at the end of the day, based on those prices. So what's a number of questions people are asking me today? They ask me this at the start of every year. Here's a list of them. Where will the S&P 500 end the year? How about the 10-year treasury yield? Where's crude oil headed? Gold and Bitcoin, always emotional asset classes. Which one is better? People always ask that. How many more times will the Fed hike rates? That's a question people are asking. Will inflation move back down to its historical average? Hopefully it does. And will the economy fall into that official recession? But I don't have the answer to any of these questions. No one does. The future is unknown. As Lao Tzu once said, those who have knowledge don't predict. Those who do predict don't have knowledge. I think that sums up how I feel about making forecasts, and particularly outlandish forecasts in something that's an unpredictable endeavor that is the investing landscape. So what should you do instead? Instead of making predictions and acting on those predictions, you should just invest based on probabilities and weigh the evidence as it comes, and use that to figure out the right path for you. And I think this is an important point. Everyone's right path is different. You have to find the right path for you, the portfolio that you can stick with over time, so that you can reap the enormous benefits of compounding. So find that portfolio that you can not only stick with, but add to during times of weakness, during tough years like 2022. And in 2023, do I have any predictions? Yes, I always have the same prediction at the start of every year. You will see many more surprises. That is the nature of markets. So I want to wish everyone a happy and healthy 2023. All the best this year. Going to be producing a lot more content this year, so stay tuned, subscribe to the channel, and look forward to bringing that to you. Thanks everyone for joining.